The $12 million contradiction. Imagine buying a 150-site mobile home park for $12 million. At 95% occupancy, the community collects approximately $1.27 million a year from lot rent, utility reimbursements, and other fees. Subtract operating expenses. Subtract almost $592,000 of annual debt service. Set aside $90,000 for future capital repairs. The owner is left with roughly $42,000 before tax. Then the sewer system fails. Estimated replacement cost, $600,000. And the contradictions continue. This park collects more than $1 million a year, yet one broken system can erase 14 years of remaining cash. That is not passive income. It is a very narrow margin for error. A monthly rent increase of only $50 could theoretically add approximately $1.43 million to the property's value. In a real Iowa community, similar pricing power contributed to proposed rent increases approaching 70% and a political backlash. So how does a $50 charge become more than $1 million of value? Why do residents who own their homes have so little control over the cost of keeping them there? And why might the greatest liability be hidden beneath a road that looks completely normal? Our hypothetical buyer is about to find out what the buyer actually owns. The acquisition closes in January. The buyer receives 150 lots, private roads, utility systems, common land, and a rent roll showing roughly 143 occupied sites. What the buyer does not receive is ownership of most of the houses. In the classic model, residents own their manufactured homes but rent the ground beneath them. They usually maintain the interiors, appliances, roofs, and structures. The park owner maintains the land, roads, drainage, water, sewer, lighting, trees, and other shared infrastructure. An apartment landlord rents the resident a building. A mobile home park investor may rent the resident only the ground and let the resident supply the most expensive structure. On the acquisition spreadsheet, this appears efficient. There are no apartment hallways to repaint, no 150 kitchens to renovate, no individual roofs to replace after every tenant leaves. The buyer appears to have purchased recurring land rent without purchasing 150 complete houses. But that efficiency depends on a customer relationship unlike almost any other form of rental housing. The customer who cannot easily leave. A manufactured home may be mobile when it leaves the factory. Years later, moving it can require specialized contractors, permits, utility disconnection, transportation, a suitable destination, and approval from the receiving community. Some older homes may be too fragile or too expensive to relocate economically. The resident's realistic exit is often to sell the home in place to another person willing to accept the same lot lease. The home is mobile in theory. Economically, it can behave like a building attached to land the resident does not own and cannot easily replace. That friction helps explain why well-run communities can maintain stable occupancy. One major public operator reported 94% occupancy in its core manufactured home portfolio for 2025. 97% of the residents in those communities owned their homes. For our buyer, that stability is attractive. Residents have invested money in their houses. Their children attend local schools. Their lives are connected to the community. Leaving is possible. It is simply much harder than moving out of an apartment. The same friction that protects occupancy also gives the owner a dangerous kind of pricing power. The $50 increase worth $1.4 million. The broker opens the financial model. Increase monthly lot rent by $50 across approximately 143 occupied sites. Each resident pays $600 more per year. The park receives roughly $85,800 of additional annual revenue. Now divide that additional income by an illustrative 6% capitalization rate, the annual return a buyer requires from the property's income. On paper, the park's value increases by approximately $1.43 million. The resident feels $50. The investor sees capitalization. One small monthly increase can become more than $1 million of theoretical property value. This is the engine that attracts investors. Raise income. Keep most expenses relatively stable. Increase net operating income. Then refinance or sell the property at a higher valuation. But the calculation assumes residents continue paying. It also assumes rent growth remains legally, politically, and socially sustainable. In 2019, residents at 2 Iowa communities discovered what happens when that assumption is pushed too far. The Haven Park backlash. Residents opened new rent notices. They already owned the homes sitting on the lots. What was becoming dramatically more expensive was the land beneath them. Haven Park communities had acquired Gulfview in North Liberty and Midwest Country Estates in Waukee. The proposed increases were reported at 58% in Gulfview and 69% in Midwest Country Estates. Residents organized. Tenant advocates became involved. The increases attracted political and national attention. Haven Park later acknowledged that it had made a mistake, reduced the increases by roughly 1/3, and said it invested more than $2 million in the two communities. The same immobility that makes revenue dependable can make a rent increase feel less like ordinary pricing and more like a charge the resident has no practical way to escape. The case does not prove that every institutional operator behaves alike. It shows what happens when investment logic collides with residents who own their houses but do not control the cost of keeping those houses in place. For our buyer, the lesson appears simple. Increase rents carefully, but the largest liability is not written in any resident's lease. It is buried beneath the road. The pipes under the profit. In February, the rent roll looks stable. Payments arrive. Occupancy remains high. The acquisition appears to be working. In March, residents near the back of the property report low water pressure. Maintenance replaces several visible components. The complaints continue. In April, engineers inspect the underground network. They find aging water lines, deteriorated connections, and sections of sewer infrastructure approaching the end of their useful life. Then the investigation expands. The private roads need resurfacing. Drainage is inadequate in one section. Previous repairs appear to have treated symptoms rather than replacing the underlying systems. The final estimate arrives, $600,000. The investor avoids replacing 150 kitchens and inherits the pipe connecting all 150 toilets. High occupancy does not protect the property when the infrastructure beneath every resident fails at once. The park still looks occupied. The homes are still standing. Revenue may continue arriving while the owner faces a capital bill larger than the property's annual cash after debt. The buyer now has 4 options. Use reserves that may not exist, borrow more money, delay the work and risk a larger failure, or raise rents and ask residents to finance infrastructure neglected before the acquisition. The buyer had treated the property's $42,000 of remaining cash as a return. It was actually the margin for error, and this property is about to use all of it. Scarcity, capital, and new restrictions. Why not build a new park with modern pipes? Because new communities can be difficult to approve. 5 local zoning resistance, infrastructure costs, land prices, and community opposition can restrict new supply. Limited supply makes existing sites more valuable. Recurring rent and stable occupancy attract institutional capital. Scarcity strengthens the owner's position, but it also increases scrutiny. The more valuable resident immobility becomes to investors, the more likely governments and lenders are to restrict how that power is used. Some major financing programs now connect favorable manufactured housing community loans with tenant site protections. These may include written notice of rent increases, renewable leases, the right to sell a home in place, and notice of a planned community sale or closure. The requirements do not cover every park and state laws differ. But the direction is clear. Pricing power is not unlimited, and even the sewer bill is not the fastest way this deal can become unprofitable. 4 financial stress tests. Start with the baseline. Annual revenue. Approximately $1.27 million. Operating expenses, -$550,000. Debt service, -$592,000. Capital reserve, -$90,000. Remaining pre-tax cash, approximately $42,000. Stress test 1. Increase the rent. The buyer raises lot rent by 8%. Revenue rises faster than expenses. Annual cash increases from approximately $42,000 to $115,000. The spreadsheet improves immediately. Resident affordability may not. This is why rent growth is so tempting. It can repair the owner's return faster than the owner can repair the property. Stress test 2. Lose 15 occupied sites. Occupancy falls from 95% to 85%. Only 15 sites stop paying, but much of the park's cost structure remains. Roads still require maintenance. Management still operates. Property taxes, insurance, and debt payments continue. The estimated $42,000 profit becomes a loss of approximately $72,000. Stress test 3. Refinance at 8%. The original loan was modeled at 6.5%. At 8%, annual debt service rises from approximately $592,000 to nearly $687,000. The base property moves from a $42,000 profit to an estimated $53,000 loss, even if occupancy and rent remain unchanged. Nothing happened to the residents, the homes, or the rent roll. The lender changed one number, and the entire investment crossed from profit into loss. Stress test 4. Replace the sewer. Now return to the $600,000 infrastructure project. Add it to the base year. The property produces an estimated loss of approximately $558,000. The buyer can borrow, contribute new equity, or postpone the repair. Every option creates another risk. More debt increases future payments. New equity reduces the investor's return. Delay threatens residents, regulation, occupancy, and the physical value of the park. The deal does not collapse because one resident leaves. It collapses when thin cash flow, expensive debt, and infrastructure neglected for decades arrive in the same year. The original investment thesis promised stable rent from resident-owned homes. The stress tests revealed the full model. Resident immobility supports occupancy. Scarcity supports rent. Rent supports valuation. Valuation supports debt. And debt leaves very little room for the systems underneath the property to fail. A mobile home park can be an exceptional business when the purchase price is disciplined, infrastructure is properly inspected, debt remains manageable, reserves are sufficient, and rent growth remains sustainable for residents. It can become destructive when the buyer pays today for future rent increases, treats resident immobility as unlimited pricing power, or mistakes deferred maintenance for profit. The owner controls management, reserves, community standards, and the condition of shared infrastructure. The owner does not fully control interest rates, insurance, regulation, resident resistance, or what decade-old pipes may reveal after the acquisition closes. A mobile home park is not really a collection of mobile homes. It is a land and infrastructure business built around customers who may own their houses but cannot fully control the ground beneath them. The residents own the homes, the investor owns the constraint.